Hello and welcome to NJ Thrive's Small Business Webinars. Today is Thursday, May 23rd, and you are attending one of our weekly webinars created to help New Jersey small business owners start, grow, and thrive. My name is Uzma. I'm a consultant here at NJSBDC, which stands for New Jersey Small Business Development Centers Network. We are a statewide program powered by the SBA, Small Business Administration, and partners to help small businesses in New Jersey with three main things. And those things are no cost small business consulting, training and events starting at $0, and exclusive small business resources. On the slide here, you see the map of New Jersey. That is, of course, the state of New Jersey with all the 21 counties. And in some counties, you'll notice that there are small SBDC logos. And those logos are where our state office and regional centers are located. So if you want to learn more about where exactly our regional centers are, which counties they cover, go to njsbdc.com and find out the exact location. In the chat, if you can go and tell us who you are, what you do, how you found out about this webinar, that would be certainly helpful for our speaker today. And as well as feel free to network and let each other know anything that you want to share about your socials, your Instagram, your website, anything that you'd like to share. All right, so the agenda, we have a couple of headlines to share about things that are happening in the small business community. Then we have our presentation and then a Q&A at the end. These are the headlines of the week all right, yep, these are the headlines. When I'm done presenting, when I'm done sharing my screen, I will share all these links in the chat and you will have them and you can go through them at your own time. I will just go through them very briefly. This first headline that we have is from NJEDA, New Jersey Economic Development Authority. This is a press release that was published last week. NJEDA expands the activation, revitalization, and transformation program to 31 municipalities across New Jersey. This is a $15 million program that will support public space and art projects along commercial corridors. Pretty cool headline. Again, it is located in 31 commercial corridor spanning 12 counties. All right, this is a second stage of strategic investments in commuter hub cities to spur economic growth. All right. And the applications are expected to open later this summer. There will be virtual and in-person information sessions. First session will be held on June 18th of next month at 11 a.m. and you can register at these links given. All right, second is an event happening from NJDMC5, New Jersey Digital Marketing Conference powered by SEM Geeks. This is happening on Thursday, June 13th from 9 a.m. to 4 p.m. Again, it is a marketing conference. And this is an in-person event. So Monmouth University. And there is an agenda and all the details about the information. If you're interested, definitely go register. All right, third is from U.S. Commercial Service, United States of America, Department of Commerce, International Trade Administration, Business Opportunities in the Caribbean Region webinar series. It started already, I believe, yesterday. Yep, May 22nd, and it is virtual. This is a webinar series, so there are webinars scheduled spanning from May to September. There is a cost for the entire series as well as each webinar, and the topics are listed here, such as close proximity, or the reasons why to do business in the Caribbean, English-speaking, free trade agreement, regional integration, third largest market in the Latin America for U.S. exports. Pretty cool. Check it out if you're interested. The links will be shared in the chat again. And fourth is Princeton Mercer Regional Chamber, New Jersey Conference for Women 2024, happening October 11th. Registration has been open. There are promotions running for early bird prices, things like that. So go ahead and register for that too. All right. So those are the headlines. Some housekeeping rules that we'd like you to follow and keep in mind. If you have any questions, put them in the Q&A box. If you put them in the chat box, they will most likely be lost and we want to address your questions in the end. So put them in the Q&A box, please. There will be no slides for today's webinar. Please keep that in mind. But if you'd like to fill out our survey, then go ahead and click on the link that will be shared for the survey. We appreciate your feedback, and this webinar is being recorded, and it will be available on our YouTube channel as well as our video library on our page. All right, so we have a special guest today. We have Christopher Hendricks, who's a portfolio manager, SBA at Provident Bank. And along with Chris, we have Ryan Silvestre, who is one of our NJSBDC Capital Team Consultant. And the topic that you're here all for today is how to prepare your business for maximum funding potential. And Chris and Ryan, the stage is yours. I will stop sharing. Welcome, and thank you for doing this for us today.
Well, thank you for having me. I actually did go to that digital marketing conference. It was you mentioned a little while ago. I went to it, I believe it was about 2 years ago. It was a good use of my time. So anybody who's who's watching this, there are a lot of people. There's a lot to meet, and there's a lot of large companies there that are beneficial for most small businesses. So it's definitely a good use of your time.
Definitely beneficial,
I like it.
for sure.
Right? All right, well, I love it. I appreciate it. Thank you for the introduction. And today, I know people sometimes say, we have a special guest, but today we really do have a really special guest, And the reason I say that is because he's on the inside. He was trained as an underwriter, which means he was the one making, or part of the team making the decision whether a deal gets funded or not. So who better to understand what credit risk looks like and how to better prepare yourself for financing than someone who was trained as an underwriter, but more importantly, now he's a portfolio manager at one of the largest banks in New Jersey. I think he's actually the oldest bank in New Jersey. And with that introduction, Chris, thank you for joining us.
Yeah, thanks for having me, Ryan.
Awesome.
So
what is a portfolio manager?
So a portfolio manager at Provident Bank specifically handles a lot of the incoming financing requests from small businesses. So we'll field calls, gather a financing package, make sure everything's buttoned up, answer any questions that a borrower may have, either pertaining to the specific loan, terms, what they may qualify for, what product would best serve them. And then we gather all that up and essentially submit it to underwriting and then walk them through the process as it goes, to ensure they have like a white glove service when dealing with the bank, and don't get overwhelmed throughout the process and are constantly updated as it moves along.
Are you also monitoring the business's financial state or health, or when they ask for a request, do you do any digging into the financial health of the company as well?
Yeah, absolutely. That's probably one of the most important things that the bank looks at. We analyze both the profit and loss or income statement and the balance sheet of the company to make sure that their historical performance has been tracking in the right direction, and also that they can support the debt or financing requirement that they're seeking from the bank.
That's awesome. So yeah, so like I said, guys, literally, one of the best people that we can have on this call today, understanding it from different perspectives, and allowing us to better prepare ourselves for funding, because ultimately, that's one of the largest reasons most businesses fail is a lack of funding. Yeah. So what we did to get now, we're going to jump right into it. We've compiled a list of the most common questions that are asked, or common obstacles that are faced by small businesses. And we're going to address them one by one here. And in between, if anybody has any questions related to one of the questions that we're talking about or addressing, feel free to throw the question into the Q&A. If it's relevant, we'll address it at that time. If not, we'll wait to the end, and then we'll do a Q&A session with you guys to make sure that everybody gets in. We'll try to get to everybody, depending on how many questions we get, to make sure that you're all as best prepared for funding. So let's start right with the very first question, which is, I think we should define funding, and define the different products. So, Chris, what are the different types of funding available for businesses? And I guess the follow-up question to that is, how do I know the right one that I should choose?
Yeah, sure. So funding options come in all different shapes and sizes. So depending on your business, they could really fluctuate, and there are different products to service every need. So funding options typically include venture capital, bringing on angel investors, crowdfunding, financing through grants, and then traditional bank financing. So within traditional bank financing, there are several different loan products that are typically offered. And again, depending on what your specific financing need or request is, including equipment financing, working capital, commercial mortgage financing, as well as lines of credits and many more options. So to answer your second part of that question, to determine which product is best for that business, can be difficult, but I think the best way to do it is identify and figure out where your business stands in terms of its growth phase. You want to know where you are in the business life cycle and what you need to propel yourself to your projected numbers and get to where you ultimately want to be. And then also determining the amount that your business can handle. So you don't want to overcapitalize the business, overextend the business, and then be straddled with large debt payments that you can't afford. You want to make it manageable, but also make sure it's effective in helping your business grow.
That's awesome, because I think one of the areas that most people miss, and I didn't do any real introductions to myself, but I've been with the SBDC for about 15 years now, helping businesses get access to capital. And a very premature, I don't know what the right word would be, direction that a lot of businesses take is the moment they see money, that's available, they go and grab it. But not all money is the right money. One of the things I would try to explain is long-term debts will always match to the long-term assets. Short-term debt will match to the short-term assets. And Chris, I think you mentioned it before. If I'm looking for equipment, then I should be looking for equipment financing, because the terms and conditions are tailored so that it's most advantageous to your business, for the cash flow cycle that not only your business has, but for the type of asset that you're securing. Again, long-term, short-term asset. To make sure that we don't stress the business, because one of the things that you mentioned in the very beginning is you're constantly monitoring the cash flow of the business as the portfolio manager to make sure that whatever the new ask is, it stays within a healthy margin, I guess, for the operation of the business.
Absolutely.
Yeah. All right, awesome. All right, so one of the questions that we have here is when creating a strong business plan, because I know that when a business knocks on the door of a lender or an investor, there's an introduction. I have no idea who you are. Give me a little bit of a summary, which is your executive summary. Your first page is your business plan, but the rest of the business plan should go into detail if the executive summary catches my attention. So what sections should be in that in that business plan? Or let me rephrase the question. What are the essential elements that should be in a business plan that lenders look for when considering funding?
Yeah, absolutely. I think the purpose of the business plan and the financing request needs to be clear and easily obtainable when picking up the document and reading through it. So if I or a lender picks up and reads the business plan, they should very easily be able to find out what the business does, why they are seeking financing, and what their plans are for future growth and development. There's nothing worse than receiving a business plan that's really convoluted, confusing, and you get through the whole thing and you still don't know what the business actually does. So that's definitely a key component.
Yeah. It's funny. I've read so many business plans where it reads more almost as if it's a commercial for the business than it is telling me the organization of the businesses. It should read like an instruction manual, and these are the steps that we're following. Right.
And then within that business plan, another very important aspect, arguably one of the most important, would point to the financial projections of the business. At the end of the day, the financials are what is going to repay the loan or the financing, whatever it may be. and they should be clear and be able to support whatever loan payments are desired. And they should tell a story of the business and where it's headed.
Anything specifically that you look for when you're looking at the financials, like any insider secrets that you can share with us?
Yeah, sure. So we like projections to be aggressive, but not overly aggressive. They should be attainable and manageable. If you're a $500,000 company, don't show on your projections that you're projecting $20 million in revenue the next year. It just doesn't make sense, and it's unsustainable for the business to maintain that growth pattern year over year.
Yep. I see that often.
Yeah, so that's definitely very important. And then having strong margins for the business, maintaining whatever gross profit margin or net profit margin you strive for, keeping that steady or even increasing year over year, trying to find certain cost efficiencies that could help improve the business future growth.
If there is going to be any type of significant growth, because if I'm knocking on your doors asking for, I don't know, $100,000 to buy new equipment, and now my business doubles, but it's doubling because of that new equipment that allowed me to go into another market, is that okay?
Yeah, absolutely. As long as it's detailed in the assumptions to the projections, and there's an explanation for, in your example, a new piece of equipment generating X dollars in sales, which will help the business be more profitable year over year. So as long as it's explained and it makes sense, that's the biggest cause for concern.
Yeah. And that's actually the I think one of the areas that I've seen where there's opportunity to clean up or tighten up a little bit, which is the assumptions page. People sometimes don't spend enough time in the assumptions page, showing this is where the logic is coming from for these numbers, but more importantly, this is where some of the data is coming from that goes not only into the financial section, but also into the narrative section of the business plan, and saying, this is why I said this number, whatever, or this claim, this statement is because of, according to census, according to the Department of Labor, or whatever it happens to be, but making sure that you cite any assumptions that that you're using in your business plan, your financials, is essential.
Yeah, absolutely. Without the assumptions, sorry to cut you off there.
No.
The projections are essentially just numbers on paper. They need to tell a story and have supporting evidence as to why and how they're going to arrive at these numbers.
Exactly. Another red flag that I see often is too many numbers that end in zero. When I see the entire projection and everything ends in a nice round number, it feels like it's a lot of guesswork.
Right.
I don't know if you have any of that similar experience, but it's very rare that you go to a supermarket and your bill ends up at exactly $100. It's usually $102.12. So the more emphasis that I put on calculating numbers based on logical assumptions, the more warm and fuzzy the underwriter starts to feel about this.
Yep. Yeah, absolutely. In a perfect world, everything would end at zeros and we'd have easy round numbers.
Exactly.
But that's, as you know and mentioned, it's not the case.
Yeah. And if anybody needs assistance with the business planner financials, that's what we do here at the SBDC. We will provide you templates, and not only templates, but guidance, so that you make sure that once you do knock on, Provident store or any lender, that there's as much traction that you've already caught to get you through those doors. But other resources available to you guys, if you go to SBA's website, or there's a bunch of private companies out there like LivePlan, not endorsing anybody, but just giving you guys some information. They do provide business plan templates as well there. So to make sure that we're keeping the right logic, in mind. But something else I want to say about business plans is that the business plan and the financial plan tell the same story. The only difference is that one tells it with numbers, the other one tells it with letters. So make sure that if you say in your narrative business plan that I'm doing the following things for marketing, I'm going to put up an ad and online, and I'm going to put up a billboard on the road, that there's a budget allocation for that on the financial side. So there's sometimes a disconnect between the two. That's very, very important. All right. So the next most popular question, how can I improve my business's financial health and credibility to increase my chances to secure funding?
Okay, yeah, that's a great question. So I would say to start, keeping up with your financial reporting is very important.
Mhm.
By staying on top of your business's financial health regularly, whether it be monitoring financials, working with your accountant more often or as much as you can, you'll discover
Yep.
certain efficiencies that can be implemented during the year, as opposed to someone who only reviews their financials when it comes time to do their taxes or at the end of the year.
Yep.
Um, so you'll be able to pick up on these efficiencies throughout the year rather than waiting till the end of the year and realize them for next year.
Yeah.
So
Yeah.
yes, the more that you review your financials and stay on top of them, I think you have a better chance of picking up on these things and staying on top of your business's health. So good software to use, and a lot of the borrowers we come across use QuickBooks and other financial reporting tools to help track and monitor their business, mainly a P&L and a balance sheet, but also depending on the complexity of businesses, it could include accounts receivable, accounts payable agings,
Mhm.
maybe inventory reports and whatnot.
Yeah. No, I'm smiling because I didn't realize how important the accountant actually is to your business. Most of us, like you said, talk to our accountants once a year, when, in the beginning of the year when it's time to prepare for your taxes. But the accountant, a good accountant that has experience not only in businesses, but in your industry, ideally, uh, can be your best friend, and we should talk to him, in my opinion, because he can chime in, with something different, but at least once a quarter. And
Yeah.
it's good. And I say once a quarter just because, for a lot of businesses, we do quarterly taxes, and we can then summarize, hey, this is how I did last quarter. This is where I want to get to by the end of the year. Am I on trajectory to get there? If not, what adjustments do I need to make? So your accountant really should be treated as a financial advisor, to make sure that you're doing the right things. And he or she will say things like, you're spending too much money on marketing, or not enough money on marketing, or too much money on payroll, or not enough money on payroll, based on the size of your business or the industry, whatever it happens to be. But based on that feedback, I can go back and make quick little adjustments. So I'm not making major adjustments at the end of the year to try and catch up. So I think that's absolutely one of the best ways to start. And for those people who are brand new at business, and this is their first year in business or thinking about going into business, spending time with someone who is experienced, like that accountant or an SBDC consultant, or any consultants for that matter, um, to make sure that the assumptions that we were talking about in the last question are within some type of standard deviation of normality, for that industry, for that geography. And unfortunately, when it's a brand new business, we don't have a lot of historical performance, so we're basing it on mostly assumptions. And then slowly, as we're starting to generate some cash flow and some traction, we start to compare, year over year or month over month, so that we can start to make more solid predictions as to what's coming. But yeah, like Chris was saying, your financials are key. Tools to make sure that you're on top of those would be QuickBooks, as kind of gold standard. Wave apps is another one that is very common, but there's a lot of different bookkeeping softwares out there. And if you're a restaurant, you might have a POS system with a very proprietary type of inventory management system or bookkeeping system. So there's a lot of options out there for that. What about on the credit side? Again, preparing to talk to the bank. Anything that I should be aware of, that I should do leading into a conversation with the bank?
Yeah, I think you should have a pretty good idea of what financing request best suits your needs.
Okay.
So you can do your own research on this and see what type of funding your business needs. Obviously, if you need financing for equipment, it's pretty straightforward. You get a loan, the bank takes the equipment as collateral, and that's kind of how it goes. It could get more complicated if you need to finance working capital. There are different loan products, different rate structures, and different offerings that the bank may have for that.
Yeah, no, I think that's important, and yeah, understanding what the ask is, that's another one that is commonly missed. So one of the first things that we should always do is almost like if we're making a cake at the house. We kind of come up with what cake am I making, and then look up the ingredients, check up the cupboards to see if I have all those ingredients, and then I make a shopping list. right? And that shopping list kind of tells you a little bit of a budget and what you're going to be spending that money on. Same exact thing with your business. So if I'm looking to buy that new piece of machinery, I make what's called the use of proceeds, which is a simple, document, it's a spreadsheet that says I'm going to be spending money on the following 5 things, 12 things, whatever happens to be. And then I start to allocate a line item or in a cost for each of those items. And I now have my budget. That's my shopping list. That's what I go with to the bank and say, this is what I want to buy. How can you guys help me out? So that's that use of proceeds is essential.
And you don't have to know.
Hmm?
Sorry, Ryan. Just one quick thing to add there.
Of course, please.
You don't have to know it all, and the bank will help you through deciding what product is best for your business and what product you should look into more or consider pursuing for financing. So there are certain value add aspects to the bank, but it is good to have a general idea and to know what you're getting yourself and your business into.
Exactly, and that's the value of a good banker, because they can be a bit more creative and say, we're going to partition your funding request into 2 different loans or 3 different loans to lower the cost of capital. We'll do equipment financing just for the equipment, but for your working capital, we'll do a line of credit as an example. So your overall goal is achieved, but the banker knows a little bit more about how to structure it. So again, you keep the most amount of money in your pocket and is the most, cost advantageous, the terms and conditions, work in favor of how you're going to use the money. It's awesome.
Yeah.
All right. So going to the next question. What are some common mistakes that entrepreneurs make when seeking funding, and how do I avoid them?
Yeah, so I would say the most common mistake that we see from business owners seeking funding is not being properly prepared. So when it comes time to apply for financing, this is a crucial time in your life. You should treat it as an interview, and you should have all of your ducks in a row. You should have a good grasp on your company's financial health, what financing your businesses can support, and what you're going to do with those funds. So you should know your business needs and at what payment level or what desired financing level you can support. Other mistakes that we see more often than we would like is companies draining the profits out of their business before they've really made it. So a lot of companies that we see or come across that poses a bit of a worry to us is companies distributing all of their profits at the end of the year, rather than leaving it within the business on the balance sheet as retained earnings to then fund future growth for the business.
Yep.
So this increases their leverage position and drains all the equity out of the company. So that sometimes a common mistake we see early on, businesses have a good year, and rather than retaining that money within the business and preparing for what could be a rough road ahead and the unknown, they distribute a lot of the profits and retained earnings, and then are left stuck when it comes time of an economic downturn or unforeseen circumstances.
Yeah, that's a great piece of advice. I haven't thought about that, but most of us, we see a payday and we want to take the payday, but we're being a bit sometimes short-sighted because retained earnings is essential for showing a strong balance sheet and showing bankability. That's a great point.
Yeah, so I'd say the best ways to avoid these mistakes are seeking out resource centers as early as you can, and working with people who have been through the process before. For example, the SBDC has been great. We've referred countless clients there. Free resource that your business can utilize to speak with experienced professionals who have been through the process before, some of whom are ex-bankers, are familiarized with the industries, and they could really help prepare you for these financing applications so that you don't come in on.
That's awesome. So one of the other mistakes that I see oftentimes is timing. People wait until the last minute. I need this money because of this that I need to jump on, tomorrow. And I'm exaggerating the example, but the longest part of the funding request to a bank is getting prepared. The once the bank has a full package, it's relatively quick and easy for them to go through the committee, and do the underwriting, and then come back with their feedback, make last minute adjustments before funding. But it's preparing that financial package, that loan package, that funding request that usually takes, on my side, on average, maybe 2 months or so to put something together that is at the right level that an underwriter feels comfortable with, making some type of assessments on. So making sure that your financials are in order, making sure that we have a business plan in place. Sometimes it's historical financials. We haven't filed our taxes, or underreporting on taxes is also another big common problem for small mom and pop or cash businesses, because it's very tempting to put down a different number on your taxes if your business is all cash, as opposed to putting the right number. But what happens is we then fail at two things. We fail at the ability to attract new dollars to continue the growth of the business, and we also fail at the valuation of the business. So the business is only worth a multiple of its bottom line. And if I decrease that bottom line because of just poor financial management or decisions, decreasing the value of my business. So if I want to do an exit and I want to sell the business, or I just want to, borrow against it, it shows that I have very little leverage or foundation to stand on. Because again, it's the multiple of its bottom line, and that multiple changes between industry and geography and whatnot. But we want to make sure we maintain a high valuation of our company as often as possible.
Yep,
Also,
absolutely. And just real quick, Ryan, to touch on the importance of preparing and gathering the complete financial package. As you mentioned, and as you very well know, businesses are always in a rush. They want the loan closed tomorrow.
Yep.
And in order to do this, you have to make sure you're doing what is required by you on your end. So as you mentioned, starting that process as early as possible, gathering all your financials, making sure your tax returns are filed. This really speeds up the back end process and getting approval later on. So I think it's a crucial part of it.
Yeah, 100%. The more time that we can prepare for financing, the better the terms and conditions, because the more you bring to the table, which lowers the risk to the bank, and pricing is always connected to the amount of risk that's associated. But more importantly, you're taking your time shopping around, so you can negotiate, see if there's a better funding opportunity out there somewhere else, so it's always in your advantage to try and plan ahead. One of my favorite quotes was from Jeff Bezos that says, "A day that I spend working at Amazon is a day that Amazon doesn't grow." And when they ask him, "What do you do?" He says, "I'm always planning for next year." That way he knows, like playing chess, he can think 2 or 3 moves ahead, and always make, more calm decisions. If I have to do things rush, there's an element of emotion that gets in there. And unfortunately, I don't make good decisions when there's emotion there, All right, awesome. So moving on to the next question. What role does personal credit history play in securing business funding, and how can it mitigate any potential challenges?
Sure. So when trying to secure financing for a business, it's a lot different than say residential mortgage financing or vehicle financing, which are very focused in on your personal credit score. So while this is a key indicator of how lenders look to individuals and how they have managed loans in the past, it's definitely not a deciding factor, although it is an important metric. So typically having a good or sufficient credit score is expected. So if there are hurdles here and credit score is not favorable to the bank, we will look for other factors to mitigate that, such as strong liquidity, but increasing the collateral requirements, etc. So in order to mitigate these challenges by personal credit, I would say monitoring your personal credit regularly, staying on top of payments, making sure personal debt is paid down to manageable levels or as low as you can get it, and then separating your personal and business finances.
That's a huge one, yeah.
Are important. Yep.
Yeah, it's oftentimes I see commingling of funds, especially for brand new businesses, people who just started something, where their checking account, for their business sometimes has personal usage, like, oh, it's just Starbucks, it's just Dunkin' Donuts, but it adds up. So aside from credit, one of the things that we like to teach people is that there are generally 5 areas, that a bank will take a look at, and credit is one of them. So most loans, like you just said, mortgages and personal credit cards and whatnot, really put a good amount of their focus on the credit. So I would say the first 3 of the 5 areas that I'm going to go into are universal. The last 2 are
Mhm.
exclusive to the world of business. But you have your credits, which generally, most banks, somewhere in the high 6s, low 7s is kind of a good base range to at least start a conversation bare minimum. As far as your average credit score, or sometimes some banks will take the median score, the medium score, or they favor a particular credit bureau. But it's credit, compensation, which is your cash flow. Show me that you have enough money to pay whatever it is you're asking for. If we're going to borrow money and the payment comes out to be $100 a month, show me that you have an extra $100 a month left over. That's as simple as I can put it. Collateral is the last one. That's universal. So it's 5 C's of lending. The first 3, again, just to recap, is credit, compensation, and collateral. And collateral doesn't have to be that I have a house that I'm going to put up for a guarantee. Chris, like I think you just mentioned a little while ago, like if I'm buying equipment, the equipment itself, it could also be looked at as collateral, right?
Yep, absolutely.
Yep, exactly. So sometimes the thing that you're buying could be the collateral itself. So credit, compensation, and collateral, the first 3 that are pretty universal. The last 2 are very important in the world of business specifically, and one of them more important today than it was in the past. But the other one is going to be character. Who are you? And why are you of value to this business? Especially if the business is a relatively newer business. So show me a little about the management team. Show me a little about you and your professional background. The last one is, I would say, more important in the last couple of years, and Chris, you can chime in on this, which is conditions, which is what's happening in the world around us, good and bad, and what are we doing about it, especially since the pandemic came around. In nobody's business plan in 2018 did they think, I'm going to include next year the pandemic that's coming by, right? But we need to have insurances in place, the ability to move quickly and pivot quickly in case something happens. So show me what's good in the world around you, and what are we doing to take advantage of it, and what potential risks are there in the world around you, and how are we protecting our interest, our business, in the event that one of those things gets triggered. So the 5 C's of lending.
Yep.
So any feedback on that?
Yeah, as you said, all very important. Conditions obviously threw a lot of people for a loop, as you mentioned, with COVID this past year.
Oh, yeah.
And I think that combined with character, shown to be true, or proved to be true, how important it is post-COVID, in seeing how businesses adjusted and reacted and adapted to the market conditions, and how they were able to, say, weather the storm, for a lack of a better word, and keep their business moving and continue on through that struggle.
Yeah, exactly. So to answer the question, credit does play a major factor in it, but Chris, I think you said perfectly in the beginning that especially in the world of business, if there are other compensating factors that are very strong, I'm very strong on the cash flow, very strong on the collateral side, I might give the credit side a little bit of a leeway, because it's being made up by one of the other factors that we put together in our credit assessment, of the risk. All right, awesome. Let's see. So next question is something most people are always asking about, the interest rates, or the payment terms, and as we addressed in the very beginning, the making sure that we match the right usage to the right, to the right type of dollars is essential. And that's where a good banker, takes shows a lot of their value. But when making just general negotiations, how do I approach negotiations with a potential lender so that I can make sure that the terms are as favorable as they should be for my business?
Yeah, absolutely. So we touched on it a few times already, but being prepared is paramount in these types of situations. Doing your research goes a long way. Obviously, there are many deciding factors that go into loan terms, interest rates, etc. But as we said before, if you have mitigating factors such as strong collateral, good personal liquidity, many other factors that you take into account, you can leverage these to an extent to gain more favorable terms for yourself and your business. So impressing a lender with a strong business plan, industry knowledge, strong operating experience, they go a long way. And never be afraid to be frank. Simply ask a lender and negotiate. Is there any way I could get a better term? How about this? How about that?
Exactly.
Yep. It's a partnership. Lending is a partnership between the business and the lender. So there's a vested interest, a mutual interest in the success of the business. The lender wants to see the business do well just as much as the business owner does. So.
Exactly. The lender makes money only when you make money. Because if you're not making money and you close up the doors, that's a loss for the bank. The bank doesn't want to see you. The bank wants to make sure that you're making money. You know, one of the most important ratios, which I'll talk about later on, ensures that you are still making money. And the bank wants to make sure that after they get their payment, you still have at least a minimum amount of profit left in your pocket that makes the bank feel comfortable, like, hey, there's enough money in here for you that you can still continue doing whatever it is that you're doing. So that's essential. It is a partnership. But I think also with the negotiation part, being realistic with also the negotiations, you know, understanding the type of risk that I am presenting to the bank, you know, and then asking if it's appropriate, the negotiations based on that perspective. You know, if I go into the bank and I have the bare minimum credit score and bare minimum cash flow, I'm not really in a position that much to negotiate. I should just be grateful, you know, that I have the ability to acquire financing and grow. But more importantly, working with that banker, working with the consultant, so that I know the next time I knock on that door, I have stronger terms. I mean, I have stronger, I don't know, situation or circumstances, so that I can negotiate and get that best type of financing. And Chris, since you work with SBA, specifically the SBA portfolio manager, SBA does take a unique place inside of that funding, you know, gamut, I guess, or spectrum, because they're designed really to help finance those that are just shy of being traditionally bankable, because some of the conditions are a little bit easier. Is that accurate statement to say?
Yeah, absolutely. The SBA typically provides a government guarantee to the bank that entices us to do riskier loans. Loans that are either under collateralized, had a tough year cash flow wise, and require projections in order to work. So not all of the businesses that we come across have the most leverage in terms of negotiations. But speaking with multiple banks and hearing what other banks have to offer, it can go a long way and let you know where your business stands specifically.
Exactly. So I'm looking at the time and I want to be respectful of everybody's time, and I want to make sure that we have enough time to answer some questions. So Chris, on the list that we have, because we have about 3 more questions, I don't want to do them injustice and just you know, breeze through them. Is there 1 or 2 that you like the most that we should jump into now? Yeah. If we have time after we get some Q&A, we'll go back and fill in the time with a question from here. But I want to make sure that we start Q&A in about the next 2 minutes or so.
Yeah, I would say either 8 or 10 regarding red flags or ongoing financial management.
Okay. All right. So let's take a look at these. All right. So yes, the question, one of the questions that we have here is, what are some red flags that lenders look for that may hinder my chances of securing funding? And then how can I address these proactively?
Yeah, so specifically, I would start with red flags regarding the financials. So red flags that would jump out would be, as we touched on before, significant inconsistencies in cash flow and profitability. We mentioned earlier that lenders like to see steady and consistent growth year over year, which shows that the business is. Sorry,
I didn't mean to cut you off, but can you give me an example of that?
Yeah. So, for instance, if a business has 500 grand in sales the first year, has a great year, is profitable, and then the next year, 200 grand in sales, loses money, and then the next year it's back up. Those types of inconsistencies create a question in the lender's eyes about sustainability of the business and if they're going to be able to repay the loan over the long term, over the term of the loan.
Yeah, it's important to also distinguish red flag doesn't mean stop sign. The bank's not going to say, oh, wait, I saw a dip in sales, not going to work with you at all. It's an opportunity to explain.
Right.
There might be a unique circumstance, such as COVID, where everybody's sales took a dip for a year or two, and then can shoot back up. Or in some of my own businesses that I've had, where there might have been a construction, that happened in front of one of mine that affected my sales for a good amount of time. So for that 1 year, my sales were lower than they were in the years prior and after. So
Yeah.
it's an opportunity, just a flag. It's an opportunity to have a conversation and say, this is what happened uniquely in that year that is not going to happen again because of XYZ, whatever XYZ happens to be.
Yep. Yeah. And as you mentioned, those are the types of hurdles that the SBA program was built for.
Yeah.
So with the right explanations and the right projections and forecasted growth for the business, these are things that we could easily get over and get around as long as we have a good explanation for them.
Exactly. So, it's gotta be good excuse makers, right?
Yep. Yeah.
Yeah. All right. So I want to start answering some of these questions. I have 3 questions so far. Let's see. Like the first question is, what type of businesses do banks typically stay away from providing funding to? Well, that's a great question. So what industries or businesses do banks typically stay away from?
Yeah, so that's it definitely varies
Yep.
depending on the business. Obviously, certain businesses have aspects that are more favorable for banks to lend to, and certain businesses are not. Just throw a statistic out there. I'm not sure what it is. 80 or 90% of restaurants, I think, experience failure within the first few years. So
Yep.
as you mentioned earlier, it's not a end all be all statement. Obviously, we have financed plenty of restaurants and look to finance restaurants, but this is one that is an industry that the bank is weary of, and make sure that we take the right steps when analyzing the application to make sure that it's going to be successful and would be able to support loan payments.
Exactly. So a lot of those industries are, again, red flags. They're not necessarily stop signs. When a business approaches us at the SBDC and it's a restaurant, like you mentioned, and I already know that I need to be extra diligent with the thought process, the building that application to make sure that the bank feels as warm and fuzzy again as we can make them feel, because that industry is considered a bit more high risk. But again, it's not a stop sign. Every business, every legal business, can get funding, and in some cases, depending on the lending institution. And then the reason I mentioned legal is because obviously New Jersey marijuana businesses are legal, but they're not legal at a federal level. So any bank that has presence in another state is a federally chartered bank, and typically they're not going to. That's going to be a national stop sign. They're not going to hear any other information other than the industry and say, "Oh, don't want to do it because I am federally chartered, so I don't do this." But some of the industries that are worth mentioning are daycares. They're considered high risk. Anything that there is environmental concerns are considered high risk. Gas stations, body shops, stuff like that. Businesses that are high cash, not cash flow, high cash businesses, where there's just cash payments like laundromats. We're definitely doing them, but we just want to make sure that the business loan package is as tight and as clean as possible. Our religious organizations, are another one too. No bank wants to be the bank that foreclosed on God. So we want to make sure that that the package is as tidy as possible. So, but hopefully that answers your that question. The next question that we have here is a SWOT analysis. Would a SWOT analysis cover all of these conditions? I think I understand the question, but Chris, do you want to chime in on that?
SWOT analysis cover all of these conditions. I'm not sure if they're referring to being prepared and in regards to the business plan.
Exactly. That's why I'm not 100% positive. Trish, if you can just add a little bit to it, but just to try and address it. A SWOT analysis, for those who don't know, is just a section of your marketing plan, which does address a lot of the position that your business takes within your marketplace, but it doesn't satisfy the rest of what a bank is looking for or a lender, is looking at. because we want to also know the methodology to how you run your business. That's the value. The business plan is your instruction manual on how you run your business. So we want to make sure that that's covered pretty well. So jumping into the next question is, what is the ideal credit score where we would see the application go through?
Yeah, so I could speak on behalf of our bank. We don't necessarily have a hard minimum. We typically like to see above 680. But like I said, if there's other mitigating factors and stronger collateral, personal liquidity, strong business operation with good historical cash flow, you can get around anything below that.
Exactly.
With those other factors.
Yep. So it's a combination of those 5 C's that we spoke about before. But it's very important that one variable by itself is never going to be sufficient to go through. And even if you have a very high credit score, it's not really a clear picture, it's a clue as to who you are. When I was 23 years old, 24 years old, and I had my first Gap credit card for the next, year or two, and I paid everything on time, my credit score is pretty high. But compared to somebody else, my mom and my dad, who might have had a lower credit score, but it shows that they have much more credit history. My score being higher than theirs didn't really hold that much weight. So it's not just the score itself, it's the entire credit profile and how that relates to all the other variables in your funding package. It's very important to distinguish. Let's see the next question. In a business that is not profitable yet, does personal liquidity help compensate? Well, that's a good question.
Yeah, I would say absolutely. But the SBA program is designed to help small businesses grow. So there has to be projections that make sense for the business to support the loan payments in the future. The SBA doesn't want to see loan payments being made just because there's someone with a strong liquid position. They want the business to be able to support the loan payments going forward. So while it can help the application process, certainly, it's not the end all be all.
So let me ask then a follow-up question, because every business, especially those that are brand new, they have a different break-even point, as to when the expenses, is overshadowed by the income. In the beginning, expenses are the bigger one, and then at some point, your income starts to become, the bigger number. If my business is not profitable for 5 months, 6 months, versus 12 months or so, is there a standard range where underwriters normally feel safe? I can be cash burning for this many months or this many years before we're profitable.
Yeah, I think it may vary slightly, but I know for startups, typically the SBA wants to see that the business is profitable and can service their debt payments within 2 years based off of monthly projections.
Yep. Perfect. Yep. And just to let you guys know, the average historical the equation, those that are consulting businesses, I work from home, that's not cash intensive at all, and a hotel that's very, very cash intensive. But the average historical break-even point is 18 months. Now depending on your business, if you're a consulting business, your break-even point might be the very first month. All I need is one client and I recuperated all my expenses. But depending on the business, a pizzeria, a laundromat, a gas station might be 5 or 6, 7 months out. The bank wants to make sure that you have reserves, the liquidity that you was just asked, to carry you through that period, and that there is a thoughtful, logical, methodical process to getting to that break-even point. So it's very, very important that we address that. And it's funny, because we just had a client. I'll make it real short because we're running out of time. But there was a client that we just got financing for, and obviously we protect the names and identities of everybody we work with, but it was a startup restaurant, and but because they were significant on their personal liquidity, which is what the question was asking, that was the strongest variable that got them over the hump and actually got them funding, because they were very strong, on a personal liquid side, even though it was a brand new business and it was a large amount of money that was being asked. It was over $1 million, and we got it funded that way. Okay.
Yep. Yeah, we've seen plenty of circumstances where the business cash flow isn't quite there yet, but these other factors such as personal liquidity, if the guy has $3 million in the bank or whatever it is relative to the loan amount, could go a long way and get the bank
Exactly.
comfortable lending to that business.
Exactly. Awesome. All right. So next question we have here is, let's see. Okay, that one was that was Margie's question. We just answered that one. Now we now have another one that is we bid for government projects, and if we were awarded for a project with a multi-million dollar, I'm assuming project, can we use this contract document to ask for a loan for working capital? Mostly for government projects, amounts we will be released after project handover. I believe I understand the question. But definitely the first part of the question I understand. Chris, any thoughts on that?
Yeah, so as long as those contracts, if they're accepted, are incorporated into the projections and the projections show that based on those contracts, your business will be able to service the debt payments. It's absolutely something that banks and other financing avenues could take a look at and try and secure financing. Like we said earlier, it's a complete package with multiple things to take into account. So there's no straightforward answer. It's a longer approach to decide whether you can get comfortable with certain financing requests, but I don't see any reason why.
Well, yeah. So, but yeah, and to I guess add to that, the contract does have a value because it is a promise to pay. However, by itself, it doesn't always have enough value to get through funding doors. But depending on the uniqueness of the business, like Chris has mentioned, a bunch of other factors, there are ways to borrow against future receivables. But depending again on all the unique circumstances that go around that particular request, a banker will say, this is the most cost advantageous structure for you. We're going to set up a line of credit, we're going to set up this, we're going to set up that in order to get you to be able to service that contract. But yeah, the contract definitely it does hold a lot of value. It's just I want to make sure that it's understood that it's not the golden ticket by itself. It has to be put together with other elements in order for it to become a golden ticket. Okay. Awesome. I think there was a question that was thrown into the chat that I saw a second ago. Well, let me just look at it real quick because I think we just finished. Oh no, we have 2 more minutes. So let's see. Do you lend? Oh yeah. So someone put a question in the chat and it says, "Do you lend to startups with the 5 Cs? We are a service-connected disabled veteran company interested in an SBA loan." So do you guys do startup financing?
Yes, so the short answer is yes. We finance a lot of startups in many different industries. So as long as their credit request makes sense, we typically like to meet with the applicants in addition to the financial package and get a good feel for their character, as you mentioned earlier, and what their business is truly about to get a full understanding. But yes, the bank's completely comfortable, especially for specifically the SBA program, completely comfortable with lending to startups and securing funding for them, as we have in the past.
Awesome. All right, so we have 1 minute left, and I'm going to finish strong with what I think is a super valuable question that we did not get a chance to answer, which I believe was question number 10. Let me just double check it. It was no, actually it was not. But yeah, I'll just ask it anyway. So Chris, when I'm looking at my bankability, I'm not an accountant, and I don't want to be an accountant. But my job as a CEO of my company is to have basic understanding of all the elements, right? So that when my accountant shows me financials, I know what I'm looking at and I can make better decisions. So I should be familiar with financials. What are the most powerful ratios that we should be looking at in order to maintain a strong bankability position?
Yeah, that's a good question. So I could go into a few, the first one being the current ratio, which is a measure of the business's liquidity. So to calculate current ratio for your specific business, take the current assets within the company, divide them by your current liabilities.
Mhm.
And as mentioned, this gives you an idea of the company's liquid assets and how you could cover short-term working capital needs.
Yep.
So another ratio that it's a little bit more complex, but I'd say one of the most important to the bank would be the debt service coverage ratio.
Yep.
And to do this, you want to calculate the EBITDA of your business, or earnings before interest, depreciation, amortization,
Mhm.
and divide that number by your annual debt service obligations. So your principal and interest on your loan payments.
Mhm.
So typically the bank looks for a ratio of 1.2 and greater. The higher the number, the better in this case. And this gives you a good idea of how much wiggle room you have with the cash flow and profitability of your business
Yep.
in order to make your debt payments.
Yep. I look at those two ratios consistently, and it was one of the first things that I look at when I am helping a small business, prepare for financing. And to put it into a simpler term for anybody who's brand new to these two ratios. But for the DSCR, the debt service coverage ratio, what 1.2 means is that you're making 120% of your expenses. So that means that I covered all my bills and I have 20% left over to play with, to do something with. That's my margin, my wiggle room that Chris just mentioned. So I just want the bank wants to make sure that, hey, you can pay all your bills and you have all this money left over, and if you do, then, kind of come give me a hug type of deal, let's work on this. But and then the current, in other ratios, there's a bunch of them, working with your bank or working with your consultants, whether it's here at SBDC or somewhere else, will teach you a little bit about what these ratios are, how to find them, but more importantly, how to monitor them and take action on them, which is the most important part. Good decisions can only be made with good information. So that's what the bank's doing, and that's what you guys do as leaders of your enterprises. All right, I think that takes us to the top of the hour. We are 3 minutes over. I apologize. 3 minutes overtime, right? I think we got all the questions answered. There were some last minute questions, but if you guys have additional questions, always feel free to reach out to us, and we can give you a more tailored response to whatever the questions are that we did not get to today. Uzma, anything that we should do at the end now to wrap things up? I don't know if you could.
Nope, nothing really needed. I think we're good. I can just put on my outro, and then we'll be good to go. So Ryan and Chris, thank you so much for today. We appreciate it. And our audience, thank you all so much for attending. We appreciate it. I think you guys did a great job with answering all the questions. And whenever there are not that many questions, I think the presenters did a great job because it covers everything. And this is one of those topics that usually we have a lot of questions. So thank you guys.
It's either a compliment to us or the exact opposite, because we confuse everybody so much, right?
A shade to someone else, I promise it's not. But
right.
This is just one of those topics that always gets questions.
Yep.
So promise it's not shade to my other speakers.
Yep. I hope it helped, guys. I hope it helped.
Yeah. All right. So thank you so much. Let me just go share my screen, and we'll just say goodbye to everyone. All right. So upcoming webinar next Tuesday. We don't have any new webinar, so this will be a replay of today's webinar. If you missed something, or if you want to refer your family member or friend, someone to attending any of our webinars, anything like that, definitely share this with them. And you can go to our Eventbrite page and register. And that is all today from us. Thank you so much for attending. We've helped 15,000 plus small businesses grow. And we've been in existence for, I think, 46 years now, Ryan, right? We celebrated our 45th anniversary last year.
Exactly.
So 46 years now, no cost small business consulting, training and events just like this one, starting at $0, exclusive small business resources. And if you would like to find out more, go to njsbc.com. All right. Thank you guys so much. Take care. Bye.
All right, guys. Go make money.
Thanks so much for having me.
All right. Thanks, man.
Take care.
Take care, guys.